Good afternoon, everyone. My name is Paul Vendrinsky. I'm one of the portfolio manager here at SIA Wealth. Just wanted to say good afternoon, some of you good morning, and also to say Happy New Year to everyone. Hopefully everyone had a good holiday, staying healthy, staying safe, and obviously to welcome you here to the first call of the year for SIA Wealth. Just to start off, the final quarter of 2021 was actually fairly similar to what we saw for the entirety of the year. A fair bit of volatility, a lot of back and forth with individual names and sectors, but saw really net gains and even some historical highs for some of the major indices as well as individual names. Overall, it was a positive year as far as performance. All of the equity mandates that we managed performed positive for the year, and we're very happy with that. But no question, in 2021 was a very difficult year for active managers. And this is when they're compared to some of the major stock market indices. I'm sure definitely this is not news to anyone. It's been a hot topic regarding many of the cap weighted names. And certainly one's reaching new all-time highs when it was able to do so with the strength of a limited number of names. It definitely wasn't a very broad-based push that put these markets where they were. And much like, say, an iceberg analogy, above the surface, the headline names that we constantly heard, especially going into the end of the year, the top performers were names such as Apple, Google, Nvidia, Amazon, those kind of names. And they were not only getting the significant media attention because of those strong gains, but also the effect they specifically had on various indices, as well as, and something else not normally spoken about had to do with those names pushing the markets where they did, and the potential risks with that, and the potential risk with the passive investing approach. Because really the other side of that iceberg is that the vast majority of names were doing something completely different in compared to those high flyers that push the markets up. In a moment here, our chief market strategist, Colin Szynski, is going to discuss this further, as it's been as we've been definitely fielding a lot of questions from you guys. And it's a very interesting topic, especially when compared to certain indices and benchmarks that have the flexibility where advisors, PMs, and a lot of funds really don't have that flexibility to do these kind of things and to move with the market. A cap weighted index, for instance, doesn't have strict concentration limits or sector restrictions that we all have. So in a time like last year, there is a real disconnect between the broader or the bigger picture of the markets. Even if you wanted, say, to replicate the S&P, you'd have a very difficult time doing so, even from a compliance point of view. In 2022, this year, maybe we'll see a bit of a regression to the mean, where the Russell 2000 names, the names that underperformed in comparisons, will advance, or maybe that the top 1/3 of, say, the S&P will reverse to that mean. We'll see. Definitely what's happened so far today, even in the markets or this year to date, we haven't seen that so far, but we'll wait and see, of course. Another reason I actually bring this up, and something that Kyle Wilson, our other portfolio manager, will explain here, looking at a couple of our funds, that going back to that iceberg analogy, back in early summer, in May actually to be exact, we started seeing that disconnect through our analysis, and it wasn't as obvious what was going on, but we did see that through our relative strength rankings. The difference in performance, or the spread between those major contributors to the bulk of the market, the bulk of the universe that we looked up, it ended up signaling a situation where we were not seeing enough opportunities to remain fully invested. And this actually ended up working very well for us. Of course, we did have exposure. We did own some of those top performers, but again, because of sector and individual restrictions, the exposure was muted as compared to what they had done in some of the benchmarks or major indices. The long story short, and Kyle will speak to this further, that because of what we saw as a lack of opportunities in certain portfolios, we accumulated up to 25% cash. And this ended up being a net benefit, especially over the past 6 months, where we managed to perform in line with most of our benchmarks and indices, but also did so with less risk. So with that said, I'll pass it on to Colin to answer some of the questions you guys have sent in to us, and then to Kyle to look at some of the portfolios, to look at the holdings, some of the changes, and some risk metrics, both on the short and longer term. Thanks. Back over to you, Colin.
Thanks very much, Paul. So in this month's Market Insights Q&A, I'm doing something a little bit different. Normally, we speak to questions that we receive from advisors. This month, I'm focusing more on a couple of questions that I received from BNN. On December the 23rd, when pretty much everybody was on holiday, they had asked me to come on after the market and just kind of talk about some of the things that are out there that are well known, or people thinking about old adages and things that are kind of not quite right, or kind of myths in a sort of way. And there were two things I ended up wanting to talk to. And as Paul mentioned, coming to the end of last year and seeing the way that the indices were acting, one of the issues that was concerning me is concentration in the markets. And I think when we look at big cap indices and at how they're comprised, I think a lot of people think, that the market basically is this big broad-based thing that gives them a lot of diversification in terms of stocks and in terms of sectors and other things. And when you look under the hood, it's not actually the case, and there's quite a bit of difference between the composition of different indices and what you're looking at when you're benchmarking. And then the second one piece I looked at was in terms of performance relative to risk. There's a lot of, and that one was really more of something in the media where they tend to focus a lot on return and not on volatility or risk or performance over the longer term. And what does it really mean? And there's like, how much risk is somebody taking on to get a certain amount of performance, as Paul alluded to a little bit earlier here, that when you're looking at some of the big cap indices, you're actually taking on more concentration risk than I think people realize. And the bigger issue with the passive investments is that they're portfolios with no breaks. If the thing rolls over, if the market cap is what it is, then you just ride it back down. Whereas at least with active managers, you have the scope and the capacity to make changes and focus on areas that are working and move away from areas that aren't working anymore. So I'm going to show a little bit of data here about some of the variations in concentration. And I'm doing this for both the Canada and the United States, looking at big cap and at small cap indices. So here is an example in the US in terms of concentration. I've got the OEX, the SPX, and NASDAQ, and the S&P 600 small cap index as an example. And just noting the 400 mid cap is pretty similar to the 600 small cap for the purposes of the discussion here. So when we look at the S&P 100, the weight of the largest single stock, and to be honest, it's actually the top two, are a little bit above 10%, and that's the case also in the NASDAQ. The S&P, it's a weight of about 7%, and in the S&P 600, it's only 0.7%. It's actually quite small. They don't have the impact of the mega caps in an index like that. The weight of the top 10 stocks in the S&P 100 is about 44%, compared with just under 30% for the S&P 500. In the NASDAQ 100, the top 10 stocks are 55% of the index, which is huge. That means the other 90 stocks are 45%. It's quite heavily weighted to a lot of these stocks. And so these last two lines here will show you as an example. That means the average weight in the index of the top 10 stocks is 5.5%. The average weight of a remaining stock in the NASDAQ 100 is 0.5%. In the S&P 500, the average weight of a top 10 stock is about 3%. The average weight of one of the remaining stocks is about 0.15%. So there's a big discrepancy and a big impact. And that's when we see something like last year. I shall speak to that in a second. Next thing I wanted to show is some of the sector concentration in some of these US indices. If we look at the S&P 100, it's most heavily concentrated in consumers, discretionary, healthcare, and the biggie is information technology. Same thing in the S&P 500. The biggest by quite a bit is information technology. And if we go to the NASDAQ, almost 80% of the NASDAQ 100 is in two sectors, technology and communications. And the third one after that is consumer discretionary at 8.8%. And a big chunk of that is because Amazon and Tesla are counted as consumer discretionary stocks. If you take those two stocks, then alone are most of that 8.8%. However, if you look at the S&P 600 small cap, it actually is fairly much more widely balanced and diversified. The biggest there in that one is actually consumer discretionary, industrials, financials, real estate has a bigger impact in the 600. Information technology still above 10%, but smaller, and you actually have a little bit more things like energy and materials as well in the S&P 600 small cap. It's actually, other than the fact that it's smaller cap stocks, is actually fairly well balanced across the spectrum. And so what does this mean? And this is another slide where I looked at the actual return and makeup of the indices. So I looked at the index return, which we would call the weighted average based on market cap. I also looked at the median return. If you literally ranked the returns of, I literally ranked all the returns of all the stocks in that universe and picked the middle one is what I did. And you would expect the median to be relatively close normally to the average. And in the case of most of them, that was actually true. The biggest difference was actually in the NASDAQ 100, where the median return was significantly below the actual return of the index, which again meant the kind of more of a focus on some of the bigger cap names. I then looked at the average return of the top 10 stocks by market cap versus the average return of the remaining stocks by market cap. And we can see that in just about every case here, there was a substantial difference. The average return of the top 10 stock by market cap in the S&P 500 was almost 50%. The remaining stocks about 30%. If you look at the S&P 100, 49% versus 26. The NASDAQ 100, 35% for the top 10, average return of the top 10 stocks, 12% of the rest. So that's showing you, especially in the case of the NASDAQ, that there is a substantial difference in return between the top market cap stocks, kind of pulled the whole index up with them. But when you start looking at the hood and underneath, not so much. Interestingly enough, and some people would say, just why would you just not buy the index? Well, if we look at the 10 best returns, I ranked all the stocks in these indices by returns in the 10 worst. You can see there's quite a variation. In the S&P 500, the average of the top 10 returning stocks was 143%, but the average of the 10 worst returns, 29%. So there is scope for and room for stock picking that can still create opportunities for active managers and for tactical rotation and tactical investment. Something else to think about was in terms of, so if you have an index average, you would say that odds are half the stocks should outperform the index and about half the stocks should underperform. And more or less for the US indices, that actually was pretty much the case, especially for the S&P and the 500 and 600. The NASDAQ, though, in actuality, about 58% of the stocks actually underperformed the index. And the other thing I looked at was what was the percentage of stocks in the index that actually had a negative return last year? For all the talk of new highs in the index and indices and other things, there are actually a sizable number of stocks that went down. So in the S&P 100 and the 500, about 12% of the stocks in the index actually lost money last year. But if you go to the NASDAQ, with its big run and its big returns for the big cap stocks, 26% of the stocks in the NASDAQ 100 actually lost money last year. The S&P 600 small cap, 23% of the stocks in that index lost money last year. That's not as much of a surprise since we did see that small caps did tend to underperform big caps over the course of the year. If we take a look now at Canada, there's also quite some interesting things I found as I went through this. So I looked at the 60, the composite, the TSX small cap, and the TSX venture, which had some interesting things in it as well. So in terms of this, the S&P TSX 60, the top 10 stocks were half the index, and the biggest individual stock was 8%. In the composite, the top 10 stocks were about 40%. In the small cap, it was more like 13%. So again, we had a significant difference in terms of the weighting. If you were a top 10 stock, had a much higher weight on average than the rest of the stocks in the index. Also, interestingly enough, some things we wouldn't think of, but there was actually quite a bit of variation among the indices. Although in Canada, we talk about financials, materials, and energy being the big weighted ones, it's there across the indices that there actually were some interesting differences. For example, in the TSX 60, 36% financials. So the big banks, the big institutions rule the roost in the TSX 60, with second being energy, and then industrials and tech actually being third and fourth. In the composite, we actually, again, you have financials at 32%, and then you have multiple sectors. Actually, this is pretty well balanced. You have energy at 13, materials at 11, industrials at 12, and technology at 10. So that's actually fairly well diversified across sectors compared to some of the other indices. If we move to the small cap, we start then seeing more of a focus shifting, a lot less of financials, only 5%, and energy and materials jump, and particularly materials jumped up to 22% to 26%. And then if you go to the venture board, well, here's our junior mining stocks, because materials were 55% of the venture board. And interestingly, though, tech pops up to 17% of the venture board, and energy at 11%. So those three sectors pretty much dominate in the micro cap space. Then when we came here and looked at a couple of things, first off, to note, in Canada, the best returning index was the TSX 60, the big cap, with a 24% return. And of these four indices, the worst was the venture, with a 7.3% return. So definitely a real weight in pushing Canada as well, favoring the big cap stocks. Moving down to look at the average return of the market caps, we saw the biggest variation in the small cap index, where the top 10 had a return of over 100%, and the remaining had an average return of about 30%. Just looking here at the 10 best returns versus the 10 worst returns, we saw as an example for the composite, the top 10 had an average of 275% return. The 10 worst had an average of about 47% return. Coming down and looking at the percentage of stocks that underperformed the index, it's significantly less than 50 for the 60 and the composite, but for the small cap and the venture, it was pretty much on 50. So overall, then that suggests the big cap stocks in Canada again did pretty well, and there was an impact of that on the index. Of course, stocks with a negative return varied from 11% in the TSX 60, 26% in the composite, up to 34% in the small cap, and 43% in the venture. So again, what this all this coming together tells us was big cap stocks had a great year, small cap stocks not so much. That when you weren't getting that trickle down effect. A lot of the index returns that we saw were very much concentrated in the small number of big cap stocks. So as I mentioned, when we look at this and we look at the different portfolios and what does that mean in risk and return, and to me as an analyst and having been a chartered financial analyst for 20 years now, to me it's really important to look at both the risk and the return, because as I noted in the media, they have a tendency to like going and talking about return and not what it took to get it, and not what risks are people taking on to get these outsized returns in some cases, or less. And so I thought it was quite a thing to note. So when evaluating managers, investors, and really I'm talking more, in this case it was more about the media in particular, often we'll look at focus on the return over a specific period of time without any consideration for the risk or the concentration or the volatility or other things. And because as we all know, some managers, some styles, some sectors, or what have you, they might look good for a while, but then they fall out of favor. And so because of that, it's important for investors to consider a number of factors when looking at what type of funds they want to be in, whether it's active or passive, whether it's mutual funds or ETFs, sectors, full markets, strategies, styles, all kinds of different things. And some of the things to consider are strategy, volatility, consistency, the risks and why performance changes over time, and what is really driving the returns of different funds. So I put up some hypothetical examples here for people to think about and consider. And essentially I used I'm assuming for the purposes of this, that the long run average return for the stock market over the last 100 years is 8%. That's the S&P for almost 100 years now. And basically, so I said, okay, well, here's 4 funds at the end of year 0. And in year 0, the client wants to start investing at the end of year 0. And you've got Fund A returned 8%, Fund B returned 8%, Fund C returned 6%, and Fund D had a loss of 10%. And then in year 1, Fund A, and year 1 and 2, Fund A had a return. They did okay in year 1, and then they did really good in year 2. And their average return after bouncing around a little bit was slightly better was about market return, the 8%-ish. Then you have Fund B that had a spectacular year in year 1, or generated 40%, and they got all over, the media was talking about them and everything else. And then just in time for year 2, when they lost 40% and ended up with a total return of a negative 16% over the 2 years. Then you have Fund C as an example of steady Eddie, a little bit less return than the market, but as consistent as you could get, return 6% all 3 years. So maybe not quite as good as the market, but a lot less volatile, a lot more consistent, and seemingly more predictable. And then you had Fund D, where for whatever reason in year 0 they had an off year. Then they blew it out and did pretty good in year 1, 14%, year 2, 6%. So again, around the market, but a little bit more volatile than Fund A, but ended up with an overall higher total return. But no, the question is, at the end of year 0, who would have guessed that the Fund D would have had theoretically the best returns over the next 2 years? And in some cases, or that at the end of year 1, Fund B that was doing so well could turn around and do so badly. And so there's a lot of different things to consider when we're looking at funds, and not just looking at just the returns isn't enough, because as we all know, past performance is not indicative of future returns. And so it's important for us to consider when we're looking at investments and for different investors, of what kind of returns are we looking at, what are we trying to make up, and as we're moving through this. So risk and return, both really important. And so I have a couple of examples. I've used some basic sector index ETFs to show just how significant some of these changes in performance can be from year to year. So for the United States, I've looked at the S&P 500 against the Bitcoin ETF, the Grayscale Bitcoin Trust, and the clean energy sector, the Global Clean Energy Index Fund. So in 2020, the Bitcoin had a smashing year, almost tripled. The clean energy sector more than doubled, and the SPX returned about 16%. So some of those were pretty spectacular. And as we know, everybody's been off talking about crypto and Bitcoin and all the rest of it. Then we get to 2021, and Bitcoin over this time has had its ups and downs. The year started out great, life was good for Bitcoin, then got smashed in the middle of the year, ended up down on the year more than 20% at one point, clawed it all back, ended up at 70%, ended up down at almost 10%. So it ended up that Bitcoin underperformed the S&P in 2021, but it was positive, but it was quite a volatile ride through that year. The clean energy sector started off positive with a gain of high teens, and by February had drifted underwater and basically remained underwater for the rest of the year, finishing with about a 24% loss. If we look at Canada, I looked at a couple of sectors here, the marijuana sector ETF, and also the capped energy index ETF. So these were, again, these are passive sector indices. So in 2020, the pot stocks started out positive, and then they kind of spent most of the year more or less kind of underwater and had a bit of a pickup near the end. The S&P TSX, same sort of thing. In 2020, had ended up with a small gain. The energy sector in 2020 got crushed during the market crash, had a bit of a rebound, but really, as we know, energy kind of lagged through 2020, and it just kind of had a bit of a pickup at the end of the year, but it wasn't enough, and it still finished the year fairly significantly underwater. 2021 was a very different story. The pot stocks had a great run in January or February 2021, and then basically spent the rest of the year going down and down and down, and ended up with about a 19% loss. The TSX finished up with a 21% gain, and a lot of this was driven by the 80% gain of the energy sector, where once we got into it, yes, it had a couple of corrections along the way, but the energy sector overall, with oil prices recovering, had a pretty spectacular run through 2021. So, I mean, at the end of 2020, pot stocks looked okay and energy was struggling, and then turned around in 2021, and energy sector had an absolutely spectacular year, and pot stocks had a terrible year. So it's important for us to recognize as investors that just sitting passively is problematic. It brings its own risks, and that there is opportunities for active managers to step in and take advantage of these sorts of swings, and to manage risk as well, so that we're not stuck in the portfolios with no brace. You have the opportunity with active management to move around and to either take advantage of opportunities, or on the other hand, to try and stay away from some of the areas that are presenting more risk. So at this point, I'm going to turn the floor over to Kyle for an update on our BMO funds.
Awesome, thanks, Colin. Some really interesting insights there into the indexes and some performance over the recent years. And now we'll just move into a review of some of our popular sub-advised funds for BMO Global Asset Management. We'll just take a look at positioning and some short-term and longer-term performance. The first fund we'll take a look at here is the BMO Tactical Global Asset Allocation ETF Fund. So taking a look at this, we've got the top 10 holdings here on the top left as of the end of the year. The portfolio is sitting at our kind of equilibrium 40% fixed income allocation. Those are in the BMO Aggregate Bond Index is a big chunk of that. That's Canadian Bond Index. We've got the BMO US Midterm Investment Grade Corporate Bonds, been a holding in the portfolio for a long time. We've had it in and out, I believe once, but been around for a while with us, as well as the short-term bond. The 5-stock portfolio currently consists of 4 stocks: NVIDIA, Simon Property Group, Ford, and AIG. And then the remaining bond portfolio is rounded out by a BMO Real Return Bond, which is an inflation hedge on the Canadian side, as well as the Mid-Provincial Bond and the Mid-Corporate Bond Index. So a relatively diversified bond portfolio with a little bit of duration risk in there. In the bottom left, you can see that our tactical allocation, the equity allocation, is sitting at 45%. So we have 15% of the portfolio right now currently sitting in short-term fixed income. That makes up the difference. As Paul mentioned at the beginning, we were looking to manage some risk and volatility in the second half of last year. Despite some of the cap-weighted indexes having a great 2021, we did see some signs of weakness in the broader US and global equity markets behind some of the largest stocks. And as a result, we did take some of the equity weight off the table. We've been pretty pleased with the positioning. It diversified the portfolio away from some equities, and it's allowed us to monitor the broader market trends through the second half of the year, while still displaying some solid portfolio returns, both on a risk-adjusted basis and an absolute basis in the second half of the year, which I'll actually just discuss here on the next slide. So over 1 year, the asset allocation fund delivered a pretty competitive 8.29% return. Looking a little longer, over 5 years, we've got a pretty consistent 6.65% annualized, which we can see that's actually slightly above the category average over 5 years, and 6.7% since inception. So this is we're pretty pleased with these longer term and shorter term results with this portfolio as kind of a balanced, a tactical balanced position and anchor within your portfolio. Taking a look at some Morningstar stats a little bit lower, over the longer term, looking at 5-year period, the risk-adjusted returns in this fund are pretty solid relative to the category. You can see a Sharpe ratio of 0.76% versus 0.58 for the category. And we've also delivered a positive alpha over that time period, while still just above zero. It is stronger than the category average. And even looking at the volatility metrics of the portfolio, we're pretty pleased with the better than category average upside, downside, and total capture ratios when compared to peers. So this is another fund that's really popular within our lineup, and when kind of taking into consideration what we want this to do within your portfolio, we believe that we've delivered pretty well for that. On the next slide, take a look at the BMO Tactical Global Equity ETF Fund. So we've listed all 14 holdings right there in the top left. Bottom left, our tactical allocation is 73% right now. So as Paul mentioned, we did take some cash. That's kind of echoed across most of our portfolios, around 25%. And that again is just so that we can, maybe manage some risk and some volatility, all while still trying to participate in the equity markets. We're kind of keeping our eyes on what opportunities are out there. Within the portfolio, the highest weighted sector is consumer discretionary, about 20%, followed by technology at 17%, and then financials at 12.6%. This is the end of the year. And kind of echoing what we mentioned with the allocation fund, we're pretty pleased with the positioning going into 2022. As we try to manage the lower breadth in the equity market, all while still trying to participate in the areas of strength. When we take a look at how the portfolio did performance-wise over the last quarter, we saw strong returns relative to the global equity category, with kind of middling returns for 2020. However, still delivered a 14% gain. Over 5 years, the portfolio has delivered a respectable 9% annualized, which is not far off the category average. With the added benefit of our true tactical investing, which is not necessarily the same for all global equity funds within the category. When we're taking a look at the 3-year over the longer term, we're pretty pleased with the risk-adjusted return. Portfolio's got the Sharpe ratio in line with the category average, just above 1, with much lower beta risk of 0.69, all while delivering a positive alpha metric versus the category. We've also achieved a better category average downside and total capture ratios. So 74 on the upside, 75 on the downside. It's almost 1, just below 1 when compared to peers, which are a little bit below that. So we're pretty pleased about that as well. Despite being in this global equity category, since we do have that true tactical benefit, we do feel that the portfolio's consistent results over the last 5 years have been a great anchor in a lot of client portfolios. And I think what we're really trying to do is give you guys peace of mind and some consistency to automate the process of tactical investing. Try to take off a little bit of risk when the opportunities may not be there. Many investors probably in 2020 or in 2021 potentially chase some massive returns from some 2020 managers, perhaps be a little bit disappointed, in an uncertain investment market. And what we think we'll continue to do is monitor the money flows and market risk, and try to align our portfolios with the areas that we believe have opportunities while avoiding the ones that don't. And when necessary, obviously, we will try to move to protect client capital and their financial futures. And with that, that's kind of summarizes the 2 funds that I wanted to go over today. I'll turn it back to Paul now to wrap it up.
Thanks a lot, Kyle. Good looking under the hood for a couple of the funds. I did want to mention that the quarterly comments and commentary have been distributed for all of our other products. We just wanted to talk about a couple of them now. We could go on for another half hour, but thought we'd just talk about the 2 bigger ones we have had questions in. So if you have any other questions, please reach out to us. Again, as I mentioned, our commentaries have been distributed for all of our other products. So let us know if you haven't seen it. Thanks, Colin, for going through the analysis on the different indices. A lot of detail to look into, and it's the questions that we've got from you guys. So we just kind of wanted to throw back some more detailed information. Let us know if you need anything else. I think in closing, this year it's going to be volatile. We've already seen that so far for the past couple of weeks here. A lot of economic uncertainty, the never-ending COVID, discussions on interest rates and inflation. There's a lot of moving parts here. So as Colin mentioned, you really need to have the ability to tactically shift, because what was good yesterday might not be good tomorrow. And you know, in keeping with our true tactical approach, we believe we're very well positioned currently in all of our portfolios. Depending on things and how they may change to the good or bad, risk on, risk off, our portfolios obviously will change with that, whether it means accumulating more cash or going the opposite way and participating more with the markets. But it will be an interesting quarter, a lot coming up this year, midterms in the US later into the fall. So a lot to, you know, keep these markets volatile. And I don't think there'll be much difference going into the rest of this year. With that, I'd like to thank everybody for joining us. Hopefully everybody stays healthy and safe. And of course, as always, we're always here for any questions you may have. Thank you very much. Have a good day, everyone.